do this.
Central.
We are in Houston. It is Central Standard Time, and we're at 3:31, so we're like a minute late.
Yeah, Ben is always screwing around and wasting a lot of time, but we are here on this lovely Monday morning. So weather is nice.
Well, it's Monday afternoon, technically, bro.
Afternoon. Ben is happy to finally have something right.
Oh.
So, yes, Ben, it is later today. But
what are we talking about today, man?
we're talking about the 10 myths in multifamily real estate.
No, I know.
Myth number one, everyone that does real estate has a lot of hair.
Ooh. Oh, we knew you had to get the bald joke in. It wouldn't be a Money Monday without it.
Absolutely.
I think at this point, like, if you don't have it, people are gonna be like, "What's going on? These guys are off today."
I know. Ferris is off his game.
So no, there's a lot of myths, and once again, folks, we want this to be interactive. A lot of people that tune in, you guys are doing deals. You guys have heard some of the stuff out on the streets, right? Dump those in the comments. Give us a like. Give us a share. We want to. These are just some of the stuff that we came up with, right? But there's plenty more out there. Let's just go ahead and kick this off, man. What do you say?
Talk about it. Let's do it.
Let's do it. All right.
You have to promise not to talk too long on any one of these, Ben.
I'm going very, very quickly all the way through them. I've got my coffee, so I'm moving fast. All right. You can quickly achieve financial freedom through multifamily investing. I think that's probably like the biggest myth.
Yeah, it's not a get-rich-quick scheme at all, right? Whether you're passive or active, both sides of it, yes, it can generate wealth, but it takes time. It's a get-rich-slow game, but you do build wealth.
Yeah, it's also one of those. It's almost like a snowball, right? The snowball is going to start off small at first, and then it starts getting bigger, and it starts getting bigger, right? It's all about momentum. But the myth that you can retire in 5 years off of this, I'd probably say is a big myth, right? Because you'd really need enough capital to get that much momentum and build up your snowball to be able to step away. But at that point, if you have that much money, why are you even busting your butt doing this in the first place? Is kind of my question, right? So I think the biggest myth that I see is people thinking that they can roll into 1 or 2, maybe 3 deals, and then they're set for life. It doesn't work like this, folks. You're going to provide a good amount of money for your family, and that's great, but you need mass to be able to really step away, especially depending on how old you are, what your circumstances are, right?
Yeah.
I'd say myth number 2, and these are not in any particular order other than the first one I'd say was probably the most important. This might actually be number 2, right? That you need a lot of experience to get kicked off, right? And I always tell the story, and as I've gotten, I guess, a little bit more confident in my career, I can say this story now. But when I first started off, I didn't really have a whole lot of experience at all, right? And why did I feel comfortable rolling into a deal? Right?
Because it kind of ties to number 3, which the myth is you need to do everything yourself.
Boom.
Right?
Bad
it's
partners.
about partners, team. It's a team sport,
Yep.
right? Whether you have bad partners or good. Oh, sorry, did I point your way, Ben? That was an accident.
Whoa,
but no, it's a team sport, right? Partners, whether they're in, exclusive or, deal partners, right? It's about figuring out who has different strengths, who has different weaknesses, and getting a deal done, right? So, you don't want to do it. You shouldn't do everything yourself, honestly. Yes, some people do. Yes, they can work, but if you don't have the experience, this is where you lean on other people. It helps.
Yeah, so bottom line, right, everybody starts at 0 is kind of the saying that I always say, right? Because at the end of the day, right, you're not going to just have a wealth of experience and then go out and do this again, right? Some people, maybe they semi-retire, they come back to it, but everybody's going to be, most of the time, coming from some corporate W-2 gig. They learned about this from a friend or a guru or something online, and then they decided, hey, that's something that I want to do. So you go out and start it, right? So you're not going to know what you don't know. That's why you need partners. That's why you don't do it all on your own, right?
I agree.
Another myth, number 4, you need to be wealthy to get involved in multifamily investing. And I'm going to say,
that kind of ties to the other 2, right?
Yeah.
Which is you don't have to do it all yourself. You
don't have to
all
be
aspects of it.
Right? Somebody on your team needs to have liquidity, needs to have net worth, but that doesn't necessarily mean that has to be you. Now, the caveat being, you probably want to have some money and some net worth and some liquidity, but you don't need a lot.
It's kind of like even on the residential side, right? Everybody, talks about starting off as a wholesaler, right? Why are there more wholesales and everything else? Because you don't need any money to be a wholesaler.
Yeah, it's
about finding a person with a problem, getting a contract, finding another person has another problem, which is they need assets, and you sell it to them. You're flipping it, right? In commercial real estate, same kind of things can be applied where, you're finding people that have different problems. This guy has liquidity, he doesn't have a deal. This guy needs a deal. If you can bridge that gap, you can go ahead and get
You're a
into
matchmaker.
multifamily. Yeah, you can be a matchmaker without bringing much money to the table, right? Now, someone, like Ben said, needs to have it. Someone needs to cover the hard costs, right? There are hard and soft costs.
Yeah.
But ultimately, does not have to be you.
Because I always tell people, right? You got the earnest money, which is probably the big chunk of money that you're going to need to get into a deal, right? But you've got other smaller hard costs, right? Like your application fee to your lender, right? That's going to be anywhere from 10 to, we've seen upwards of 50 grand, right? You might have to pay for your due diligence, right? If your property management or your general contractor doesn't do it for free, most of them don't, unless you're just a long-term client. Right, and even then you might have to pay for something. That's probably going to cost you $25 to $50 per door, right? You're going to have to pay for that, right? Sometimes your lawyer, they might get the bulk of what they get paid for, at closing, but they might want a retainer, right? Call that 5 to 10 grand, right? So all this stuff kind of adds up. So somebody's going to have some money, right? But once again, like Ferris pointed out, right, it might not necessarily be you. Maybe you found the deal, you found the guy or gal that has the cash. And boom, sounds like a match made in heaven, right? That's the starting of a partnership right there, right?
Yep.
Number 5, you should start smaller. I hear this one all the time. You have a great story I'd like you to tell, right? When starting off as a real estate investor, right? Kind of go through your
I was going to do my
progression.
own 32-unit deal in northern Houston.
Yep.
And I'm glad I did not win that deal, right? Ultimately, I learned about syndication. Okay, I realized kind of the value of it. And just hopped in and figured it out, right? Allowed me to do a bigger deal and really kind of continue to do something that's scalable. Because even if I did that 32 unit, I would have done it myself and we
wouldn't be doing this probably.
Wouldn't be here. And how long would it take to have gotten enough money to go do the next 32 unit, right?
Who knows,
right? Versus this can be scaled, right? Again, you're finding people with different problems and you're filling the gaps. So,
and I think a lot of people, they think that they need to start smaller because of.
Or were you talking about the residential story? Is that what you're talking about?
Well, no. I was talking about I was talking about your 32 unit because that's a great example of what people tend to which is how much can I afford, right? And maybe me and maybe a friend or two or a family member or two like as a JV, and then they just back into what is that as far as unit counts go, right? And for some people that might be a 10 unit, for some people that might be a 50 unit, right? But that's how they look at it when they get into real estate. A lot of people just don't understand the syndication side, and they get scared of the amount of zeros that are on the transaction, right? A $10 million deal, a $3 million raise, right? For some people, they're like, oh, whoa, I'm not ready to do that. I don't have any way to do that. And in some cases, maybe they don't. But then it goes back to finding somebody that can help you get into that deal, right? And that's all about partnerships and not doing everything on your own, right? So don't think small, right? Because small is you're going to get ground up. Unless you have your own property management company, you have some mechanism to be able to maintain those, you're undoubtedly going to get dragged into the muck, right? So you need to understand that that 32 unit or that 10 unit or that 15 unit, you're going to spend a lot of time, and that's going to take you away from funding your next deal. That's going to take away money from investing in your next deal. So that's a big myth that we see. Right?
Yeah, absolutely.
So I'll pause there. Any questions, comments?
If people have comments, questions, go ahead and chime in. Money Mondays, do this every Monday, 3:30 Central.
Boom,
Let's see.
boom.
Ronnie says, what's up, guys? Jefferson
Ronnie,
says,
Ronnie.
happy Monday, guys. What's up and happy Monday to both of you.
Hey guys. All
Ronnie
right.
says, myth, you need to be in a guru program to do deals and raise money.
That's a good point. This is why I want it to be interactive.
That's a good myth, actually.
And just to kind of to add to that, right? I think a lot of people, they put this thing up on a pedestal because of the transaction sizes, and then they think that they need training or mentoring to be able to go out and do it. And don't get me wrong, I went down that route, so I'm not here to say that one way is better than the other. But the myth that we're trying to bust here is that everybody has to go that route, right? And I think that's not true. And so people are getting deals done that have never gone through any formal training or mentoring, and that's totally fine, right? They're going to probably learn from a partner or from somebody else that's in the deal, right?
Absolutely.
In some cases they're just going to learn along the way.
Yeah, you learn as you go, right? And learn from others. It's not about being a guru group. Right? Ultimately, guru groups is a newer phenomenon, I'd say.
It is.
People knew how to buy real estate previous to that.
I think the one thing that it gave me was an ecosystem that I could kind of tap into, right? I would say that the formal training that I got was a little light. And I think ultimately what I always tell people is that you're going to learn way more on that first deal just doing it and being there and rolling up your sleeves and understanding how the process works and when you need to do that certain thing and at what time, than you ever would in any kind of amount of training or mentoring, right? But if you guys ever need, a recommendation, we've got a couple. Hit us up offline. There's a couple guys that actually do the business the right way. So, going on to number 6. Moving along. Stocks are safer than multifamily real estate investing.
Much safer. So safe. No.
I'm gonna put up a little bit of an example, right? I'm not gonna name names, but it was somebody that I know. His dad worked for Enron. Had the majority of his stock allocation in Enron stock, as was encouraged by the management team there, and he lost over 7 figures when Enron went bust, right? Also tell all the people in 8, 9, and 10 who took a bath on their portfolios, if stocks are safer.
And ultimately, and that aside, right? Like, yes, markets go up and down just like real estate, but to me, real estate is real. There is that component of it, right?
Yeah.
And the other piece I think that's really different than stocks is ultimately, you have a CEO that does something fraudulent, shady, whatever you want to call it. That has a big impact.
That has a huge impact.
And as a shareholder, almost no shareholders have any sort of conduit to the company, right? Like you have no ability to chime in on anything, really, right? Unless you are an extremely large shareholder, which we're not talking about that, right?
Yeah.
But ultimately, we run the properties. People are able to call us and ask questions and get feedback and give guidance, right?
Yeah.
So that's the other thing to kind of keep in mind.
No, and I love that, right? And I think, I was talking to a wealthy guy, this is earlier in my career, and, he ultimately said, how much is the land worth? How much, if we're looking at this on a per square foot basis, the thing burns to the ground, right? What is the land worth? And it's worth something. Right? And that's ultimately what I love about real estate. Yes, you can touch it and you can feel it, and most of the time that's never going to happen, that the whole entire property is going to burn to the ground. In fact, I've never heard of that actually happening. That's why there's multiple buildings. But let's just say that it does. That land that property is on is worth something, so it'll never go to zero. And I think, with stocks, the potential of it going to zero, Enron, is possible. Right, and so that's ultimately why I feel like that's a myth. And there's probably going to be some people that are going to, that are more stock driven, and they're probably going to say something there, and that's fine, right? To each their own. We have stock allocation in our portfolio too, right? Everybody should, right? We just tend to, like real estate a little bit better.
It's a lot more fun.
It's a lot more fun, right? All right, number 7, you can achieve economics of scale for every multifamily property. I'm going to say that is a big myth, right? Where I think people think that, I've got, one 100 unit property in one submarket, so therefore I'm going to get the best plumbing costs and the best appliance, prices and the best landscaping contracts, right? I think ultimately that's not possible, right? You need to have enough mass in a specific submarket. You need 20 100 unit properties, and then you can go back and start negotiating some of these things, right? So I think people tend to think that it's like that, and unfortunately it's not, right? You are going to have economies of scale, but it's not going to be to the extent where you're just going to be able to drive your costs down 20%, right? It just doesn't work like that. Number 8, multifamily is harder to finance than single family. Now, you've done a lot of single-family stuff, right? Why don't you talk about the process a little bit, man?
Single-family is such a pain. It really is, right? It's because there's a lot of regulations, a lot of rules, and I guess they have a lot more people that just kind of fraudulent, or the government actually, I guess, maybe it's more so the government got really involved in the single-family space, right? Because they're trying to stop what happened previously, right, in 2009, and so the Dodd-Frank Act. I like to say that I buy apartment complexes, and it's a lot less work on the debt.
Oh my
gosh.
I
literally fill out so much less paperwork. Nobody's grilling me for it or asking for quadruple verification of everything you mentioned. Right. So really, apartments, now there are requirements, right? It is a game. You have to play within the constraints of that rule, right? Around liquidity, your current net worth. There's some things that you have to. But if you check those boxes, and you're done. It's not like single family where you check the boxes and like, well, maybe it's checked, and hey, can you verify, and can your friend's friend verify, and if I ask 3 people in 3 different, it's none of that nonsense, right? It's very straightforward in multifamily, which is what I like.
It's credit score and debt to income ratio and comps, right?
I don't know if they care about credit score in commercial, actually.
No, I'm talking about on single family.
Okay.
Yeah, on the residential side, right? Whereas on commercial, right, it's about the team. It's about the submarket. It's about the plan.
Yeah, because
right?
I wonder if
And it's
someone has
because-
really crappy credit, do they care? I don't think they do.
I don't think that I
long
mean,
as-
I certainly don't have an 800
I know that
credit score. I'll tell you that.
they pull a credit score. I know that.
No, they do, and they'll do a background check. So you guys need to realize that they're doing a credit and background check every time, right? But once again, we were talking about this with a gal last week, right? It's cumulative, right? Once again, you have somebody that's on your team that has a really great credit score, and maybe yours isn't all that great. Well, guess what? It's going to balance out because they're going to take the average of the two, right? And so, but it's a commercial loan and it's a business, so therefore they're looking more about who's the person that's going to run the business, right? What's the business plan, right? What's the exit strategy, right? And then ultimately they're going to look at the submarket too, right? But these days they're looking at the sponsorship group, right? And are these guys and gals capable of doing what they say that they're going to do, right? Whereas residential, they don't really care, right? It's like, do you have the money in the bank, or do you have it coming in through your W-2? Is your credit score there? And is it all backed up by an appraisal?
Absolutely.
And then on top of that, 1,000 pieces of paperwork, right? So, bottom line, that's a big myth. It is a lot easier to buy multifamily and to finance it than it is to buy a single family home. Number 9, multifamily properties will be too expensive to maintain and operate. Well, in some cases they can be a little bit expensive, right? But I think you can.
I would say who cares? Like, who cares? Fundamentally, who cares? It's part of the business plan.
It's all about
that's
what I
your
was about to
numbers.
say.
You're expecting to spend that money, right?
Yeah.
If I have a machine that I have to put $1 in and it spends $100,000 of gold out, I mean, okay, I'll put the dollar in, right? Like,
Yeah.
does it matter? It's part of the cost, right? It's part of the plan. You know it. Now, you do have more potential for error, right?
Yeah.
More things, there's more systems. You have to make sure you have a good property management company, right? But again, like, who cares is maybe my feedback on that, right? And I hear that a lot because I know a lot of people, in my family or my family's friends, they do land, they do retail, right? They like their triple net lease, right? Because it's a lot less headache. I mean, so what? Like, and if I can cash flow more on an apartment than I can on a triple net lease, I'm probably the one happy. Yes, I have more costs. Yes, I have more expenses, right? Revenue and expenses, they're a different kind of ratio. But ultimately, in my philosophy is it's part of the business plan, right? As long as it's what I expected going in.
And I always talk about it's the more hurdles, the more hard it is, the more friction there is to get in and do things, the less likely you're going to have competition, right? Right now there's a lot of guys and gals chasing deals, right? Probably more so than there was 5 years ago when we started off. But, bottom line, this is still, you still have to have money to operate these properties. You still need to have knowledge, and there's still a level of risk, right? So, and anything that you do, there's going to be an expense to it, right? So don't think that, I got to spend $100 or taxes. They're really expensive, right? You build all of those into your projections and your models and your analysis, and then then you're trying to still determine, does this deal make sense from a return standpoint, right? So who cares if it takes $1 million a door every freaking month to operate the property if I'm making $10 million, right? Like, I mean, you got to look at it like that, right? Same thing with the purchase price. People get caught up in this, it's expensive, right? But it's all based on the rents that you can achieve, right? If you're making $10,000 a door per month, right? Maybe it's worth $500,000 a door, right? Who knows, right? And I'm just throwing out crazy numbers, but you guys get my point. So, number 10, you can easily control the value of your multifamily property, right?
Yeah, and I'd say,
it's kind of we were talking about this.
It's a little bit of a myth, not easily, right?
We were talking about
what's nice
pre-show.
about commercial versus single family, you can't control it at all.
No,
right?
why? Because it's based on
tied
comps.
to the comps, right?
Yep.
You need the whole neighborhood to increase. It's really hard. But multifamily, you can control it to an extent, meaning I can do things that drive value, that improve my NOI, which improves value. Right? Now, the problem is it's the easily that bothers me. You can control it, but not easily. It's a lot of work to usually boost NOI.
Yeah.
Right? And short of the previous owner just completely missing obvious ways to boost it, doing a turnaround or a value add takes time. It takes a year of work, right?
Yep.
2 years of work, depending on what you're doing. And so, can you do it? Yes. Is it easy? No.
No, I agree. Right? It's not going to be something that you're just going to turn on a switch and you're better than the last guy, right? There's definitely a lot of work that goes into it, right? Especially on a lease up, right? I'd say where we've seen the biggest driver of value, right, is we take these hairy deals that were completely unstabilized and underperforming.
I have a good joke.
What's up?
We take on hairy deals to help Ben get more hair.
Oh,
I never connected that dot until just now, but I thought that was pretty well.
That's pretty good, man. That's pretty
I
good.
gotta use that one more.
No, but I mean, you can think about it, folks, right? Like you've got something that is achieving $30,000 less, and say it's 30 units, 1,000 units, or $1,000 a unit, right? So $30,000 in income, right? If I could just each month bring units online, I'm increasing the value by. I mean, you apply a cap rate to that, and you guys can kind of do the math. Right, put a 5 cap on that, right? Whatever that comes out to. I mean, probably a lot. I'm not a math whiz, right? I use Excel and calculators. So, bottom line, like he said, you can, but you can't do it easily. So that's another big myth, right? So, did we miss anything? Is there anybody else have something?
So Money Mondays, it's every Monday, 3:30 Central. If you have comments, questions, let us know. We usually present something. If you have ideas for future topics, let us know, and we will present on it. This one actually came from one of our audience guests. And so ultimately, we spend the first 20 minutes presenting, then 10 minutes Q&A. We're about in the Q&A, so if you have comments, questions, let us know. We will answer them live.
Do it.
So Ronnie says, great place to start, but not a place you can scale. I think the single family thing, so yeah. Nelson James says, what's the minimum size property? What's the minimum size property does one need to achieve economies of scale in multifamily?
I wouldn't say property. I'd say, properties, and I'd say really to get a good bulk contract on something, you're talking 1,000, 2,000
Yeah, but
units,
if you're talking about on a specific property, how many units should you have to have economies of scale within the property? 80 and up, right? Where you can support full-time payroll, right? We won't buy anything less than 80. It just becomes too much of a hassle.
Yeah,
right?
so there's a management component that makes it very, very challenging, right? Because you have to have the revenue coming in to have the full-time staff, which we need to have because that's just our business model. But I mean, I would say in a sub-market, which is when I think of economies of scale, I'm never really just necessarily thinking about one property. I'm thinking about them all mixed together. Right, I'd say you start achieving that at about 1,000 to 2,000 units, and then it just gets better from there, right? Because you can go back to that landscaper and say, hey, I've got a 10-pack of properties. You're charging me $2,500 for each individual deal. I'm giving you 10 right now. What can you do for me? Okay, I can do that for $1,500. Boom, you just saved $1,000 per property. Not bad, right? And that stuff actually happens. That's what we do, and we're doing it on the management side too, right? That's why you build up some mass on the management side so you can go out, you have purchasing power with these vendors and these supply houses across the country, right? So something to think about.
So let's see, who else? We have comments, questions, let us know, we'll answer them just fine. I do see one question from Jefferson. For a next future topic, step-by-step checklist from LOI acceptance to day one that you own the property.
I don't know if that can be covered in a 30-minute show, but
No, it's basically the process from LOI to owning the property. We could talk about the key things, right? Like what happens after you have an accepted LOI between DD and closing, I guess is kind of, really it's what happens during DD, what happens during closing. I think that's the question. That's how I'd interpret it.
Yeah, we could do that. You can do that.
Yeah, definitely. It's a good topic. We'll do that. So let's see. So who else has comments, questions? Let us know. Otherwise, we will keep going. Ben, continue on.
Toolkit. All right. DisruptEquity.com/toolkit. Check it out. Shannon does a great job curating it. We got the checklist. I don't know if we have that one, but we will certainly, once we do it for a show, we will add it to it. Our webinar replays, including these, right? It's all going to be there. Podcasts that me and Ferris are on. We talk about all kinds of crazy stuff on these podcasts. They throw all kinds of curveballs at us and a lot more, right? And it's completely and totally free. So check it out there if you would. DisruptEquity.com/toolkit. So talking about next week, oh my gosh.
We're talking about top investing metrics in commercial real estate and how to use them. So this one's an important one, right? KPIs, your metrics, your numbers that matter in real estate. So
no, and this is important, folks. This kind of goes back to not only just on what we look for on the projections, right, on the return side, but I think we can maybe sprinkle in some asset management, metrics as well. I think is important. Lease trade out, that type of stuff, right? Why do we track this stuff? Why is it important? And how do you guys ultimately calculate this stuff? So, trying to kind of get into some more underwriting too, which we're going to be doing some more underwriting as well. So check that out. But any other comments, questions?
all
right.
Let's see.
So we'll go ahead and
We'll call it
wrap
a
up.
wrap.
I love it. I love it. See you guys next
Thank
week.
you all next week. We'll see you